Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just interviewed Zach Walkerlieb, managing partner of Willow Manor, one of the luxury real estate investment groups here in Las Vegas. And what he did is he gave us some great metrics that he looks at when he's taking a look at market outlook and housing trends. Anthony, what was a takeaway or two that you had?
Well, I'll tell you, a big concern people are having right now is the impact of inflation. Right? How's that going to be with the buying power of your dollar? So we want to invest or put those dollars into assets that are going to increase with inflation. And when we look at real estate, there's going to be a few impacts of inflation in there. One will be the inflation will automatically increase the value of the home or the appreciation. But also as an investor, inflation will allow you to increase your rent. And if you can get in ideally with a 30-year fixed mortgage, so your expenses for the most part are staying the same, but you'll be able to increase your rent. So I really like the impact of inflation. Cam, what were some of your takeaways?
Yeah, I liked some of the perspective that he was sharing with us. One of the things that he shared was that he does believe a lot, along with a lot of others, that there is a recession that is pending or coming for the U.S., but the point that he made was that a recession does not necessarily mean that real estate market is going to drop. Yes, most recently in 2008, they did drop together, but doesn't necessarily mean that they're correlated. And he gave us some great statistics to kind of follow and back that up. One of them being is that the difference between now and what it looked like in '08 is there's a lot of equity that people have in their homes, and it's really difficult for people to turn and just kind of walk away from that equity. And then he kind of looked at it from a bank's perspective, and that banks are currently kind of bending over backwards to keep people in houses right now. And so he doesn't see banks kind of utilizing that foreclosure option. Number one, because they're trying to keep them in there. And then number two is he shared with us just how long foreclosure is taking. And it was over 900 days that the typical foreclosure takes. And so great perspective, right? Not only perspective, but really kind of backing it up with data. And that's why we brought him back. So really enjoyed this interview.
Enjoy the episode.
Take care.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Zach, we are excited to have you back. This is going to be your second time on the show. We had you back, or we had you on previously, and you were able to share some great insights on the real estate market, not only in Vegas, but nationally as well. So we're looking forward to kind of diving into today's conversation. But before you do that, how about you share a little bit about your background with our listeners that may or may not be familiar with you?
Absolutely. Thanks for having me back, guys. I'm really excited to be on today. So I am here in Las Vegas, been in real estate for about 11 years now. Currently own my own team, Willow Manor. We focus on luxury and investments here in Las Vegas. But over my career, some of my accomplishments have been I've won top 30 under 30 internationally for Coldwell Banker twice. I've been named one of the top 30 under 30 for the National Association of Realtors as well, and top 40 under 40 a few times as well, and always been a high producer in the real estate industry. And now we have one of the highest producing teams, and we aim to be the number one team in Las Vegas in the next few years. So great career, but also locally, I'm on Keystone Corporation and Las Vegas Global Economic Alliance, which is our economic development board, and Vegas Chamber. Stay very active in the community as well.
Great, man. No, this is why we like having you on, is because you're not just your local, but you've got a very national perspective. And so we appreciate that. Zach, just to kind of get us started here, what are some of the key metrics that you typically look at as you're maybe forecasting, right, the housing trends or market outlook for yourself and for clients?
I take a pretty holistic approach to this, but I also look at the globe. I try to look at geopolitics, the economy, how everything looks, because it's all tied together, and real estate is going to be affected by it. So right now we have a lot of chaos going on in the world, obviously.
To say the least, right?
As of March 31st, as this is being recorded, we've got quite a lot going on, and there's some big changes coming down the pipeline, I think. And some people are aware of it, some people aren't. Obviously, the Russia-Ukraine thing is playing a significant role in supply chains, and there's probably going to be some shortages that we need to consider. But the economy is what I'm looking at overall right now within the United States. That is going to be the most important thing that affects housing and investments overall, how you're looking at everything. Our economy does not look good. We just, for the first time, since 2019, we had the 2-year, 10-year yield curve invert yesterday. And that was the first time. And when that happens, every time since 1955 that has happened, within the next 6 to 24 months, there's been a recession. So you could expect a recession sometime soon. My gut is telling me that 2023 will be a little bit rough as the Fed increases interest rates to combat the crazy inflation that we're experiencing. You're going to have a lot of ripple effects of that. The money markets are going to tighten. Business loans are going to become a little bit harder to get, or they're not going to make as much sense. And that's also going to impact mortgages and the real estate industry as well. So that's the general outlook for what's coming. And then we can kind of dive into what that all means.
Yeah, let's dive into it. So kind of the big takeaway that I heard is a lot of uncertainty, right? Just in the world, and then also kind of in the US here. And what I heard you say is your expectation is a potential recession 2023. So how does that translate to somebody that's looking to buy and sell a house, both on kind of a personal level, right? Maybe a personal residence, but also from an investor's point of view?
So let's look at it like this. If you've got $100,000 in the bank, let's look at it on the purchasing side of things. So whether it's an investment or a personal home, you've got $100,000 sitting in the bank, or $50,000, whatever it is. Let's take $100,000. Over the next 5 years, because of inflation, that $100,000 is going to be worth $50,000 in 5 years. That's just what is going to happen. We're at 8% inflation right now. I would expect 10% inflation before it starts to taper down, even with what the Fed is doing, unless they become a little bit more drastic and they raise it by more than the 0.25 rate, which that could stem it and not make it hit 10%. But anyways, roughly your $100,000 is going to have a $50,000 valuation in 5 years. So you're deciding, what do I do with my money at this point in time that would protect it the most and hopefully make it gain value? That's what we're trying to do, both protect and gain value. So if you put it into the median home in real estate and you invest at, let's call it 400,000 across the country, in Las Vegas it's about 475, 485, 495, right around there, depending on the specific thing that you're looking at. Let's say 400,000. You're not going to lose $100,000 in that. We're not going to have that kind of a pullback in real estate. We're just not. We're not going to experience 2008 again. The average homeowner in Las Vegas has $185,000 in equity. And that's typically the case across the country. We're experiencing a lot of things like hedge funds buying properties en masse again. 1 in 5 properties being purchased right now across the country is from an investor. That means cash. Those aren't these crazy loans that were going on in 2008. That's a lot of people, both homeowners and investors, that are holding equity. The average foreclosure process right now takes 932 days.
Whoa. Dang,
You're
man.
not going to see foreclosures come. Hard stop period. You're not going to see foreclosures come like they did in the past. 932 days. And besides that, what banks are doing is they're doing this forbearance or, term period where people can delay payments. So the last thing that they're getting to, they're like, I can't pay, I can't do this. Banks are allowing them to take a year off of paying their mortgage and just tacking that year on to the back of their loan, because they don't want to go into the foreclosure nightmare that happened. They want people to stay in the home and keep taking care of it and keep paying. So not only do you have a year of non-payment coming down the pipeline for a lot of people, on top of that, they already have equity, most likely. And they're not going to get foreclosed on for 932 days. So you're just not going to see the foreclosure crisis that we saw in 2008, period. What we could see is a drawback, a little bit of a drawback, 5%, something like that. This is obviously absent a catastrophic thing like the collapse of the dollar or something like that occurring. You know, let's just say all things maintain normal. You could experience a little pullback, but we're not going to see something crazy. So where is your $100,000 protected in terms of real estate? I think it's fairly well protected, especially if you're leveraging in, because if you're investing into the home as an actual investment, you hopefully have cash flow, someone paying your mortgage every month, someone paying you back, and it doesn't matter if the price goes up or down, you're getting income on it, and your $100,000 is just staying there with the market's doing this or that. It doesn't matter. And I think personally, over a 10-year run from now, home prices are going to be anywhere from 30 to 100% more than they are right now, simply due to the amount of money we're printing as a country and what I think is going to be coming down the pipeline too. So hold real estate. I think it's a great investment, whether it's personal or not. Meaning whether it's a personal home or whether it's an investment for you.
Zach, you said something interesting about, and maybe these banks learn from 08 about the downside of foreclosing and then having to hold that and then sell that property. But I like the idea that they're just kind of tack it on at the end. But aren't most mortgages kind of packaged and sold off to investors? Would they still have the ability to change or to add that on the back end?
Yeah, whoever the mortgage servicer is, yeah, it's
okay.
It's up to how it all works. I mean, it's very costly to foreclose on someone. It's very costly, especially if there's damage done to the property and all of that stuff. It makes sense to try and keep someone in a home in most scenarios.
There's a couple of things there. One is you kind of mentioned that you're expecting a recession 2023. And then the kind of economic outlook that I think you gave was actually pretty optimistic for real estate. Was there a disconnect there, or can you explain that kind of difference between the two of them? Maybe it's short-sighted versus kind of a longer run or longer view. Could you help me there, Zach?
Yeah. So if you go back historically, most recessions don't equate to a drop in housing. You still will see moderate appreciation in real estate. And we have, as most people know by now, we have an incredible inventory crisis in the United States. Now, there are a few data points that I think are worthy of pointing out as we continue the conversation. One of which being, and we can go deeper into this later on, but one of this being that brand new home build inventory is the highest it's been since 2008. That data point just came out, which I was not expecting to hear, because that goes against everything that I understand the market to be. When I heard that data point, I said, "Whoop."
Give us that again, if you don't mind.
New build inventory across the United States is the highest it's been since 2008. With that being said, resale home inventory is the lowest it's ever been across the United States. So we have an incredibly low inventory across the United States, which I think is going to continue for 7 to 10 years. We don't have the inventory available, and we won't have it for a long time. We underbuilt drastically. And I think you guys actually had a great demographer on, which I gave a listen to that podcast. I loved it.
Yeah.
He talked about, and this is widely known in real estate too, how underbuilt we are as relative to the generational size. So baby boomers, Gen X, millennials, and Gen Z. Millennials are a huge portion of the population, and as they're coming into being able to purchase homes, We have a massive dearth of inventory because we never built enough homes. So I'll give national numbers just so that people can kind of understand this. Actually, let's do local because it's more at home and it reflects nationally. In Las Vegas, we get hit with 2008.
Mm-hmm.
And in 2003 to 2008, we were building like 25,000 new homes a year, 30,000 new homes a year. From 2008 until 2019, we were building 7,000 new homes a year.
Mm.
And we had double the amount of people moving here, essentially. So not only were we building less than a third of what we were building before, we had more people moving into Las Vegas. We're still only building about 9,000, 10,000 new homes each year. We were building 25, 30,000 new homes a year in Las Vegas. And that is also reflected nationally. We just did not build enough homes. And so, and that as urban populations become bigger and bigger and bigger, we've got a big inventory crisis on our hands, and we will have that for many years to come. And so if you can hold an asset that is limited in its availability, holds its value over time, and one that you can leverage cheap debt into, I think that real estate is a no-brainer over the long run. If you were to say, hey, Zach, I got someplace to put my money over the next 1-2 years and then pull it out, I might go, hold on there, buddy. maybe not right now. Maybe look at a different thing. I'm not sure. That would be a much more detailed and specific conversation, but over a 10-year run, pretty hard to beat.
Zach, one of the questions you just answered it, but I have a statistic that I'd like to share that goes along with it. One of the questions I had for you is on the new builds is new construction keeping up with demand? You've already just addressed it, but the reason I was going to ask that is because one of the stats that I came across in prepping for this was that residential land in 2020 was priced at $250,000 per acre, where 2021 it was $514,000 per acre. And I was looking for some insight, right? You've already addressed it, but just what kind of impact that has on developers and builders, along with whether that's they absorb that or whether they just pass that right on to the consumer.
Well, here's why there's so many variables in this, is because the cost of a builder is now going up dramatically. They're also experiencing an increase in interest rates. Not only that, they're experiencing and have been an increase in lumber, an increase in labor costs, a supply chain shortage. They're experiencing all that too, which is also causing prices to go up. And so as they experience a tightening of capital and interest rates going up, that means it's going to be more expensive for them to build. And there's going to become a point where it doesn't make sense to build anymore because they're not going to be able to get that on the sell side of things. And so that's going to cause an even bigger problem in terms of inventory down the road. We will likely have, as a consequence of what's coming, an even bigger problem with housing people, especially new home builders or lower and middle income people. It's going to be very difficult to afford housing down the road. And that's both renters and homeowners. It's going to be tough because of the policy of printing so much money and what that's done to inflation and our economy, and recklessly spending and spending it in poor ways.
Well, we definitely agree with you on that one. Now, you even mentioned, and they're starting to now, of interest rates rising. What effect, if we were just I know there's like a big soup. There's a lot of things. There's inflation and supply and demand. If we were just to carve out the interest rate, how will that impact the housing as the interest rates go up? So what a lot of people in the real estate world seem to forget so easily is that in 2018, interest rates went up, and they went up to 4.5%, 5%. And what happened was our market slowed down for a period of time, and we were like, oh man, is this it? Are we going to get hit? Because it did impact the market, and then interest rates went right back down and our market just roared, and we are where we are now as a result of that.
So interest rates do impact the real estate market pretty seriously. Here's some numbers for you to reference. Applications for mortgages are down 8% as of February. 8% as of February. Applications for refinancing are down 50%. Okay. And that is as of February before rate increases. You're going to have a much more significant slowdown in mortgage applications once we experience these increases. It's already happening. An 8% reduction in applying for a mortgage, buying a home, is huge, huge. And that's before the rate increases that we've experienced. And that's not even anything compared to what's coming. I mean, the rate increases that the Fed is going to have to do, if they don't do massive rate increases, inflation is going to eat people alive. And it would be very, very bad. So they have to increase the rates at a pretty serious clip, meaning mortgage applications are going to go down. That doesn't mean that that's going to necessarily, we need more inventory. We need things to open up a little bit more. We need it to balance out. So is the result going to be a softening? Is it going to be a little bit of a pullback? Is it going to be a collapse? I don't think so. Or is it going to continue to appreciate? I think we're somewhere in the middle of that. I think it's going to be a softening, a little bounce up and down on the line, maybe, and then continuing on, absent, again, anything crazy.
Yeah, that's what I would I mean, I think that interest rates increasing is gonna, like with most people, they don't go and try to find a house for 400,000. What mortgage number are they comfortable with? And as interest rates decrease, the buying power increases, and then the inverse is happening. So I can see that being an adjustment, but with all the other things going on with the inventory, with inflation, I mean,
yeah, a lot of people talk about, well, we just put in so much money into the economy. We printed this crazy amount of money. What's the impact of that? Because that means we've got so much room to grow in terms of home prices, right? Because if we added that much money to the system, that must mean that home prices can go up that percentage still. Well, the reality is, you got to look at the monthly payment for the normal person. So if you look at the median home price across the country, the average monthly payment has gone up by $400 already, which is a 27% increase to what they were at. So if you have a 27% increase in the average monthly payment for the median home across the country, that's a pretty significant increase. And so as that goes even further, you're going to have that cost of the mortgage be pretty seriously impacted, and buyers will not be able to afford the purchasing anymore. There is definitely going to be an impact. The question is, how severe is this going to be?
There's an article that came out today. We've kind of addressed it, but just to kind of bring it to the forefront, there's an article that was in the press today, and the title literally said, "No end in sight in the Las Vegas market as prices boom." There's two stats. You've already addressed a couple of them. Home prices are up 26% from last year, January to January. They described the Las Vegas market as irrational. And at the bottom of the article, it said, perhaps you should stay where you're at and let this irrational market settle down. What are your thoughts on that, right? Do you think people should be moving? Think what's some opportunities there?
This is an irrational market. What does that mean, though? Here's my two recent listings. 475 list price. We sold it for 525, waiving appraisal contingency, paying cash difference, proof of funds already in. Okay. So, and we had 15 offers, 5 of which were cash. Listed another one at 400,000, 50 offers, over 40 of them were cash. So it's not always the home buyer that is doing this. There's a ton of money and equity coming into this that's driving it because we have such limited inventory. So is this an irrational market? 100%. It's craziness. It's craziness. With that being said, the money's there. The money's speaking. People are putting their equity into the homes right up front. They're not walking away from $100,000 of equity the same way that 2008, where they put 0 down payment and own 4 houses. It's just not the same thing. I think that if someone is considering a move for a particular reason, or they want to liquidate a portfolio, that's a very specific conversation that someone would need to have. They would need to say, okay, I want to downsize. Is now the right time? I might go, yeah, now might be the right time to take your money out of a huge asset, leverage it into a smaller asset, more in the median home price range, live in that forever, and maybe diversify some investment in either other real estate or other things. If someone had a portfolio of real estate, we could discuss what the best investment structure would look like for that too. But it's becomes a very specific answer there to the individual. If you're in a median home, sit in the home, man, ride it out.
What opportunities do you see for investors? Right, maybe here in Las Vegas market. Is it single family homes, right? As a rental? Is it condos? What are you seeing, Zach?
The best thing to invest in right now seems to be corporate rentals. And what that means is 30-day leases, fully furnished, 30-day or more contracts. You're getting the highest ratio difference on your monthly rent income. So if, let's say, something was renting out for $2,500 normally, you could get $4,500 or $5,000 simply by putting furniture in there and calling it a corporate rental. Airbnbs are going to open up in July, so you're going to have some Airbnbs come to market. But that's still an unknown how costly that's going to be to have an Airbnb, and are there going to be associated fees that are going to chip away at the overall return. I would look abroad right now. I wouldn't necessarily look in Las Vegas unless you were really active in the market. I would look across the country for other things. I'm a bit concerned about our landlord-tenant laws. I'm a bit concerned about what legislation will do to housing. And I think as you move into states like Florida, Texas, Alabama, Kansas, there's some great stories about what people are doing. South Carolina, that I think look really, really interesting.
You know, what happened with Zillow?
Yeah, well, don't count Zillow out. I think it's silly. I think that people who are saying Zillow's done in the iBuying game is probably wrong. I think they're wrong. Zillow will probably come back around. Zillow was trying to buy market share. It's the same thing that like Uber and Lyft did, right? Uber would undercut taxis by a massive margin and then provide better service. Well, Zillow was attempting to do the same kind of model. They were saying, we're going to eat the cost for a long period of time because we have all this Wall Street money funding us, so we don't need to make a profit. We just need to have the capital available to us, and we'll just eat those costs as long as we possibly can. And so they were overbidding on properties simply so that the seller would be like, hey, I sold my home to Zillow for a crazy price. Hey, you should too, because you might get a crazy price. Well, that bit them in the ass. They didn't do it well. And they were left holding an incredibly expensive inventory that they're now liquidating. There's other ones that are out there doing it. OfferPad, Open Door. They're trying to play the game. And here's the reality of it, that every real estate agent and everyone in the market needs to understand. These guys are going to get better and better and better and better at it. Maybe some of them fail. Maybe not. Amazon's probably going to come into the game eventually, and they're going to get good. And they're probably going to take about 10 to 25% of the market over time, because people like pressing a button, and even if it costs them money, even if it costs them thousands of dollars because they're losing it, instead of going to the market, it's easy. And so a lot of people will do it at the end of the day, especially as things get tighter and tighter and better for them. But a lot of these models only survive in up markets. As soon as there is a down market, that changes. A great example is during COVID, Opendoor stopped purchasing entirely. They were like, we don't know what to do, we're out. And they just stopped for a period of time at the very beginning. And you see that kind of stuff all the time behind the scenes that the public might not be really aware of, but as a real estate agent, you're in tune with what's happening, and you're seeing these companies come and go based on the market. And so as things become more turbulent and chaotic, I would expect a few of these companies to hit some hard points. And maybe Zillow saw that coming.
Zach, awesome, man. We appreciate you coming on and sharing your insights as always. If somebody wants to talk to you a little bit more, maybe go through their specific scenario, where can they find you?
Give me a call on my personal cell, 702-743-9998, or you can visit our team website, willowmanorgroup.com. But always happy to chat on my personal cell.
Awesome. We'll make sure we include both of those in the show notes.
Yeah.
Awesome, guys.
Thanks again, Zach. We really appreciate you coming on and sharing your wisdom.
You're very welcome. It was great seeing you guys.
Go make it a fantastic day.
Take care.